Welcome back. This week, we are diving deep into a critical S&P 500 analysis for March 2nd, 2026. Since hitting 7,002.28 on January 28th, the market has been grinding sideways. Is this a healthy consolidation, or are we witnessing a major peak formation? When the market moves laterally, identifying short cycles with absolute certainty is a challenge. Let's dive into the data together to see if we can uncover the answer. Before we start, make sure you read the disclaimer carefully. Starting with the big picture, the 18-month cycle. Since our last update in early February, the monthly chart hasn't provided much new data. Our 40-week cycle target of $7,321 remains valid, as the market is still trading above its cycle line and its valid trend line, VTL. From a long-term perspective, the S&P 500 remains bullish. The first warning sign of a reversal will be a cross below the cycle line, followed by crossing below the VTL to confirm a true bearish trend. We are still anticipating the next 18-month cycle low this summer. Moving to the 40-week cycle. I previously discussed two potential scenarios for the cycle low. The first was November 21st, and the second was late January. Based on recent price action, November 21st, 2025 remains the superior label for the 40-week low. Recently, the S&P 500 dipped slightly below its VTL. While a sharp move below this line is a major bearish signal, the current sideways drift makes the signal a bit murky. Technically, a VTL cross suggests the next longer cycle, the 18-month cycle, has peaked or is currently forming that peak. Is the 18-month peak already behind us? High probability suggests yes. We must monitor the 40-week cycle line, the blue FLD, on your screen. A break below this would confirm both the 40-week and 18-month peaks, signaling a bearish trend until the next lows in July or August 2026. The $7,321 target stands unless we cross the 40-week cycle line first. The 20-week cycle. Per the Hurst rule of synchronicity, the last 20-week low matched the 40-week low on November 21st. We've traded near the cycle line for 2 weeks, with 14 weeks now elapsed. To hit the Hurst nominal average of 19.48 weeks, we need about 5.5 more weeks, placing the next low in late March or early April. We expect the S&P 500 to cross below its cycle line shortly and stay there until that low forms, eventually acting as resistance during the final descent toward the summer lows in July or August. Before we keep going, please take 2 seconds to subscribe for the weekly cycle updates and market timing, and hit the like button if you find this analysis helpful. The 80-day cycle. Let's look at the 80-day cycle, a textbook case of resolving multiple low candidates. We had 3 dates, January 20, which is 60 days long, February 5th, 76 days long, and February 17 is 88 days long. By comparing these to the 68-day nominal average, we can mathematically eliminate February 17th, which is 29% too long. So we still have 2 possible candidates. To find the 80-day low. First, we have to find the 80-day peak. In the Hurst toolbox, we have a very reliable tool, which is the VTL or valid trend line. According to the Hurst principles, when prices cross below the VTL, this confirms the peak of the longer cycle is formed or in formation. The last 40-day cycle was on January 2nd. By drawing a VTL between the November 21st low and the January 2nd, the 40-day VTL provides the answer. On January 20th, the S&P 500 gapped sharply below this VTL, confirming the 80-day peak was in place. Since a new high of 7,002.28 formed on January 28th, the only logical label for the 80-day low is January 20th. We now expect the next low around March 30th, notably the February 13th cross below the cycle line at 6,832.90 gives us a downside target of 6,663. In conclusion, to wrap things up, the S&P 500 is currently at a massive crossroads that will define the rest of 2026. While the long-term trend still shows some resilience above the VTL, the evidence from our shorter cycles, specifically the 80-day and 20-week analysis, is sounding the alarm. The sharp gap below the 40-day VTL on January 20th was a textbook signal that the peak is likely behind us. If the S&P 500 fails to bounce and instead breaks firmly below the 40-week FLD at our current levels, the $7,321 target will be officially off the table. In that scenario, we are looking at a sustained bearish trend leading us all the way into the summer months. We must remain disciplined and wait for the market to confirm which path it chooses, a final spike to the target or a long slide into the July or August lows. Don't forget to subscribe for weekly cycle updates and market timing. Hit the like button if you find this technical analysis helpful. Comment below, do you think we hit the 18-month peak in January? Thank you.